Hey everyone, my name is Lex Morgan, and today we're diving into one of the most structurally important stories in the global commodities market right now, the silver supply deficit of 2026, and the critical question investors are asking. Is a major price surge coming? This isn't a hype video. This isn't retail speculation. This is a macro, institutional level breakdown of what's happening beneath the surface of the silver market. From mine supply constraints and industrial demand acceleration to monetary policy, capital flows, and forward price modeling. Because when you strip away the noise, silver in 2026 is not behaving like a normal metal. It's behaving like a market under structural stress. Let's start with the core reality. The silver market has now entered multiple consecutive years of physical deficit. According to the latest consolidated data from industry surveys and exchange inventory reports, global silver demand has been exceeding total annual supply by a significant margin. In 2024 and 2025, the deficit widened as industrial consumption surged, while mine output struggled to expand meaningfully. By early 2026, preliminary projections suggest that the deficit may remain elevated, potentially above 150 to 200 million ounces annually, depending on final photovoltaic installation numbers and industrial activity levels. To understand how serious that is, you have to understand scale. Total annual silver supply globally typically sits in the range of 1 billion ounces. A 150 to 200 million ounce deficit represents roughly 15 to 20% of total supply. That is not a minor imbalance. That is structural. Now here's the key issue. Deficits in precious metals don't immediately cause price spikes. They cause inventory drawdowns first, and that's exactly what we've been seeing. Exchange-tracked silver inventories, particularly in major vaulting systems, have been steadily declining over the past several years. What matters more than total registered inventory is available for delivery metal. The amount of silver classified as registered, meaning ready to satisfy futures contracts, has fallen sharply compared to historical norms. When inventory declines occur gradually, markets can absorb them. But when industrial users continue drawing physical metal at elevated rates, while investment demand returns simultaneously, the pressure compounds. And that's the tension building in 2026. Let's talk about the demand side, because this is where the story changes dramatically compared to previous cycles. Silver is no longer just a monetary metal or jewelry asset. It has become strategically embedded in the global energy transition. Photovoltaic solar installations are one of the largest drivers of incremental demand. Silver paste is used in solar panels for conductivity. Even with ongoing efforts to reduce silver intensity per panel, total demand has grown because installation volume has exploded. Emerging markets are accelerating renewable deployment, while developed economies continue to subsidize green infrastructure. At the same time, electric vehicles require significantly more silver than internal combustion engine cars. Silver is used in high-performance electrical contacts, battery management systems, and charging infrastructure. As EV penetration rates increase globally, silver's industrial footprint expands. Then we layer in electronics, 5G infrastructure, AI-related data center expansion, medical applications, and high-end semiconductor uses. Silver's unmatched conductivity makes it difficult to substitute in many advanced technologies without sacrificing performance. So what we're seeing in 2026 is not just cyclical demand, it's structural industrial demand growth. Now flip to supply. Unlike gold, silver is rarely mined as a primary product. Approximately 70 to 75% of global silver production comes as a byproduct of mining other metals, primarily copper, lead, zinc, and gold. That means silver supply growth is not directly responsive to silver prices alone. It depends heavily on base metal mining economics. If copper producers are cutting capital expenditure due to economic slowdown fears, silver supply may stagnate even if silver prices rise. That creates an inelastic supply curve in the short to medium term. Mine grades have also been gradually declining in several major producing regions. New discoveries are limited, permitting processes are longer, environmental regulations are stricter, and geopolitical risks are rising in key mining jurisdictions. Add to that labor costs, energy input costs, and financing constraints, and you have a situation where bringing new supply online is neither fast nor cheap. So we now have a structural industrial demand base colliding with constrained, largely inelastic supply. That's the foundation of the 2026 deficit. But here's where it gets interesting. Price behavior hasn't yet fully reflected this structural tension. Why? Because silver doesn't trade purely on physical fundamentals. It trades as a hybrid asset, part industrial metal, part precious metal, part monetary hedge, part speculative instrument. That means macro liquidity matters. Throughout the past tightening cycle, central banks globally raised interest rates aggressively to combat inflation. Higher real yields generally pressure precious metals because they increase the opportunity cost of holding non-yielding assets. However, as we move through 2026, monetary policy expectations are shifting. Inflation has moderated from peak levels, economic growth in several developed economies has slowed, and markets are increasingly pricing in rate stabilization or eventual easing. If real yields begin declining while industrial demand remains strong, silver enters a powerful macro tailwind scenario. Historically, silver has exhibited asymmetric upside behavior during periods of monetary easing combined with tight physical markets. The gold-to-silver ratio often compresses during these phases, as silver tends to outperform gold in late-cycle reflationary environments. Now let's talk about inventories more deeply. There is a difference between visible exchange inventory and total above-ground stock. Critics argue that there is plenty of silver above ground. Technically, that's true, but accessibility matters. A large portion of silver is embedded in industrial products and not economically recoverable in the short term. Recycling does provide additional supply, especially when prices rise. However, recycling flows are price-sensitive and often lag initial price increases. Furthermore, industrial scrap recovery efficiency varies significantly by region. The key point is this: when annual deficits persist, the market slowly tightens until something breaks, either demand destruction via higher prices or supply response via investment. So what happens next? There are several possible scenarios for the silver market direction in 2026 and beyond. Scenario 1. Controlled rebalancing. In this case, industrial demand growth moderates slightly due to economic cooling, while recycling increases and mine supply stabilizes. The deficit narrows but does not disappear. Prices gradually trend higher but remain within a controlled range, potentially climbing steadily rather than spiking. This would resemble a slow bull market driven by fundamentals rather than speculation. Scenario 2. Monetary pivot plus investment surge. If central banks begin cutting rates or signal a strong easing cycle, investment flows into precious metals could accelerate sharply. ETFs, futures positioning, and retail physical demand could all rise simultaneously. In a structurally tight physical market, that creates explosive conditions. Silver historically moves faster than gold in percentage terms when speculative capital enters. In that case, price spikes toward previous cycle highs, and potentially beyond, become plausible. Volatility increases dramatically. Short squeezes in futures markets become possible if physical delivery tightness intensifies. Scenario 3. Industrial slowdown shock. If global manufacturing contracts sharply and renewable investment slows, industrial silver demand could decline. That would relieve some physical pressure and potentially delay price acceleration. However, even in this scenario, monetary easing could offset industrial weakness. Now let's address a critical point investors often misunderstand. A supply deficit does not mean immediate price doubling. Markets are forward-looking. Prices adjust based on expectations of future tightening, not current deficits alone. Right now, the silver market appears to be in a tension-building phase. The physical fundamentals are tightening quietly, while macro conditions are on the verge of shifting. This combination historically precedes powerful moves, but timing is always uncertain. Another layer to consider is geopolitical fragmentation. As global trade blocs become more regionally aligned, strategic metals gain importance. Silver is not officially classified as a critical mineral everywhere, but its role in solar and electronics makes it strategically important. If governments begin prioritizing domestic supply chains, stockpiling behavior could emerge. That would remove additional metal from open markets. Let's also discuss positioning. Futures market positioning shows periods of heavy speculative short interest, followed by covering rallies. Silver is known for sharp short squeezes because its market is smaller and more volatile than gold. When positioning becomes crowded on one side, reversals can be violent. From a technical standpoint, multi-year consolidation ranges often resolve with strong directional breakouts. If silver breaks above major resistance levels with strong volume, algorithmic momentum strategies could amplify the move. So which direction might silver move? Given the structural deficit, constrained supply elasticity, accelerating industrial applications, and potential macro liquidity shifts, the bias appears skewed to the upside over a multi-year horizon. However, silver rarely moves in straight lines. It is historically volatile. Corrections of 15 to 25% within broader uptrends are common. Investors need to differentiate between long-term structural positioning and short-term trading noise. If industrial demand remains elevated into late 2026 and monetary policy eases even modestly, silver could transition from consolidation into expansion phase pricing. The key metrics to monitor include real interest rates, exchange inventory levels, photovoltaic installation data, EV production growth, recycling supply response, futures market positioning, dollar strength trends. If real rates fall while inventories continue declining, that's a powerful bullish setup. If inventories stabilize and industrial demand weakens sharply, that's a caution signal. In many ways, silver in 2026 sits at the intersection of green energy transformation and monetary regime transition. It is not just a metal. It is a conductivity asset in a digital electrified economy. And that structural transformation is not a short-term narrative. It's a decade-long shift. So is a price surge coming? The conditions for one are forming, but markets move when catalysts align. Watch policy, watch liquidity, watch inventories, watch positioning. If those vectors converge, silver's move could be fast and non-linear. And if you want deep macro breakdowns like this, no hype, no noise, just structural analysis, make sure you subscribe to the channel. Because in markets like this, preparation is everything. I'm Lex Morgan, and I'll see you in the next one.